Good morning, Atul, and good to have you on board. The markets are really on a firm terrain as we're looking at D Street moving from strength to strength. Wanted to get in your view as to how you're reading into the overall setup for the equity markets. While today might be a mild aberration, the undertone of the market has certainly been nothing less than impressive.
Yeah, so essentially, I hold the view that this is global in nature. And if you look at the starting point, it is the easy liquidity that is being provided by the US Fed and a lot of Feds across the world, which is fueling an asset class rally. It's not just equities, it's even commodities, it's cryptos, it is your private equity space, it's your SPACs. So what you are seeing is that this liquidity, which is really a big gush, is inflating all asset classes. And there's no harm to it because a lot of people are making money. The big risk to this inflationary trade is in case we have inflation. If inflation goes up, then the Fed and the other central bankers will be compelled to tighten a bit. And for us, last week was a very important week because, the US inflation numbers that came up were at around 5%, which was much higher than the street expected. But the interesting thing was that the bond market, which is a reflection of expectations of liquidity or interest rates, really were not so worried. So as long as the market is not worried about inflation or is not worried about tightening liquidity, I think equity markets and a lot of other asset classes can move higher. So specifically speaking about the US bond market, because that I think is going to give us a clue as to when markets turn around or when the correction is more substantial. So what we really see in the US bond markets is that, they have in the last 1 year moved from 0.5 to almost 1.74. And that's a very, very big market move in the debt market point of view. But they have really sort of come down. And I really think that they could head to around 1.34. So they're around, say, 1.47 right now. So this, I feel, will propel in the short-term markets, equity markets, I think, to a 4 to 5% higher. And for the Nifty also, it will be a positive leg up. The emerging markets are a big risk-on trade. And when bond yields fall, you see the risk-on trade playing out. So I do feel that we could see about another 5 to 6% up move in equities. As I said, the important thing is how much liquidity the Fed provides. And a very good indication, as I repeat, is going to be inflation. If the fear of inflation gets to central bankers globally, I think that is when tightening will happen. And that is when this whole asset up move could come under a bit of check. Till then, I'm really not worried on a day-to-day basis.
Looking at inflation as one of the key concerns. Atul, with COVID having really taken over, the consumer behavior patterns of customers has changed quite drastically. In light of this, what is it that you're expecting when it comes to the FMCG companies in terms of their overall demand scenario, pivoting, strategizing, and rechanging and rethinking their overall business models and the way they operate?
So FMCG has always been a mainstay, and I think the biggest thematic move for India is the whole, the great demographic story, and FMCG consumption comes in a big way to it. So I really don't think that it is really going to be a sector which is going to be, falling out of favor and things like that very fast. I think these are very, very good secular stories. They may be slow, they may not be exciting, but I do feel that, sectors like FMCG, I think sectors like pharma, healthcare, and more so healthcare, I think post the COVID is something which is going to see a lot more allocations in individual household budgets or whether it's the governments, etc. So I think that these are some very good backbone sectors, IT for that matter. I mean, the whole digitization that has got accelerated thanks to COVID. So I feel these are sectors which are the backbone sectors, which I think that you must have a bulk of your allocation in if you really want to sleep well at night. And in between, you will see some sectors doing ups and downs based on certain pronouncements or certain things like that. So coming to your point, sectors like FMCG, pharma, IT, I think these are real backbone structures, not just to the Indian economy, but to the globe as a whole, to the world as a whole. So I feel that these are great sectors where you can compound wealth. And these are companies and managements which have proven themselves over cycles and times. So they may be slightly up and down here and there, a quarter here, a quarter there, but sooner or later, due to the inherent strength in these companies, the kind of cash that they have, the kind of themes that are playing out, I feel that they tend to be wealth creators in the long run. As I said, they don't give you excitement in the short run. They don't give you that kind of spurt or that kind of high that traders look for. But for investors, they definitely have been the greatest wealth creators in the last 5 to 10 years. And I see no reason why that will not happen in the years to come.
Sure. Atul, that seems to be spelling out very true for metals as well, given the kind of super cycle that we are in. And I mean, year to date, we're already sitting at 66% a surge on the Nifty metal index alone, and I'm not even talking about individual stocks here. This in addition to the Power 2020 that we've already had for the metals. Having said that, off late, there are some, market participants and brokerages raising its hands on how much more headroom could this super cycle for metals may have, and whether it's now beginning to top out. On the charts, is there any such indication? Because in the last fortnight, reacting to some of those brokerages, you did have down days on metals, but that very swiftly got bought into.
Years, and it's not about 15 days or a month. So when you look at some of the play that's happening in metals, in fact, commodities as a whole, I mean, you look at something called the CRB index, which is a very good representation of commodities. You'll find that the CRB index has taken out a multi-year breakout. And very often when these breakouts happen after years of underperformance, or, the trend which has been down for commodities since 2008, commodities have not had a good time till they bottomed out in 2020. So it's a 12-year bear market in commodities. I think that trend has changed. And when you have a decadal trend that's changing, that's when you call it a super cycle. So in this journey up, you will have weeks, months when it will underperform. But again, it is something which is very, very exciting. It is something which is unloved, which we have honestly all forgotten to analyze and pay attention to. But just that the price performance has been so dramatic, we really have to, get our hats. And if it is a super cycle, then I guess there's a lot more to come. So even right now, one may not be too late. Obviously, the time frame, as I said, has to be the super cycle time frame and not 15 days. So you will have people saying overvalued, undervalued, demand, China, etc. There'll be a lot of stories around the way. But the thing is, just as I mentioned in the earlier sectors, if you're talking about a super cycle in commodities, then I think you're talking about a multi-year move. And in that, it's never too late, really.
From the last time we spoke to now, what one has also seen is the re-emergence or comeback of PSE names. And, the entire PSU bank, including banks, has seen some phenomenal moves, led, of course, by the big boy SBI. Within the banks, you've also seen a BOB, PNB, Can Bank, what have you, the entire pack hold out. Similar is the case with the rest of the PSUs as well. While there hasn't been much of a talk on disinvestment per se, but you've seen the entire space charged up. What happens here, Atul? Because, most believe that up until you actually see the first successful disinvestment go through, they would want to be wary and stay aloof from the PSU pack. But, the stocks are doing something completely different.
Absolutely. I mean, and this, Aisha, is something which you're seeing globally. So what happens is, coming to my first thing about interest rates, when interest rates go up, or there is a fear that interest rates will go up, growth takes a backseat. That is why you will notice that it's not just in India. You will find that globally, growth stocks have had a bit of a flattish quarter or thereabouts. If you look at the NASDAQ, or even if you look at some of the big tech or FANG stocks, they've corrected substantially. So whenever there is a fear that interest rates will rise, people go into value. So there is this big battle between growth and value. Value has underperformed, as I said, again for a decade, and there are some green shoots that is happening. However, if the fear or the thought is that interest rates will not go up, you will start seeing growth emerge. And I think that is something that will happen in the coming few weeks, because I just mentioned earlier that I do see bond yields in the US correcting another 10 bips further. And this will propel growth. You will see that happening in the NASDAQ, where IT stocks will again, I feel, make a new high. Even in India, you'll find the IT index, pharma, and all these, growth related, which actually have underperformed for the last 3 to 4 months, to again have a leg up. And that comes to your point of PSUs. PSUs is the ultimate value trade, because this is something where you've got some real hard assets, great monopolies, companies which some are managed okay and things like that, but available very, very cheap. The valuations are very cheap. And so the play out of the value trade is reflected in the movement in the public sector banks and public sector undertakings. So in case the value trade plays out, it's well and good. But in case growth gets back, then I think that these guys can also take a pause or a bit of rest. And there are actually two questions. The second is, I think, very interesting, is what's happening in the banking space. Banking is a sector which is the most overweight sector in our index. So it finds reflection in most fund managers' portfolios. And again, almost for a decade, since 2008, it's private sector banks that have led the charge. However, what you're seeing right now is that, I mean, if you look at the last 3 months, the bank Nifty has been an underperformer compared to the Nifty. The Nifty is up about 5% on a 3-month basis. The bank Nifty is down -1%. But in this phase, the PSU banks are up 7%. And the private sector banks are -3%. So this is a very, very rare case where you find that first, the bank Nifty has underperformed the Nifty on a 3-month basis. And in this also, the PSU banks have outperformed the private sector banks. So, this is again, as I said, that these are very, very decadal kind of moves. These are big changes that are happening. Whether this goes and solidifies into a larger term trend, the question is still a begging. But I think these are some very interesting points, and these are points which find reflection in fund managers in their strategies, because ultimately you want to be with a larger trend. Ultimately, you make money with the trend, and it's our job to really navigate in and out. So the move or the allocation moving a little from the private to the PSUs is something that is very, very visible. It's interesting and something you have to take notice of.
Absolutely. Atul, good morning. Financials as a basket, they've really been lagging, Atul. And on the back of the growth story and all the factors you've just underlined, you would anticipate that would also pick up. But what's the trend indicating in terms of pace or, again, strategy within the basket? Because overall, they've just severely been lagging.
Absolutely. I mean, this is something which, if you ask anybody, it's a consensus trade that banks and financials will do well. But the screen is saying something else. As I pointed out, in the last 3 months, the Nifty is up about 5%. The bank Nifty is not taken out a new high, in fact, lifetime high. So that really tells you the amount that there is, and yet there is consensus bullishness on banks and financials. So there is a bit of a mismatch. The screen, or as I say, the market is saying something else. The general noise or consensus is talking about something else. So for me, in my PMS, I'm underweight banks and financials. It's a very courageous call. It's a very difficult call, because when banks move, they tend to move the market. There are monsters out there. So to be underweight banks and financials is a bit of a tough call, but we are underweight in that space. We feel that what is going to do well are certain niche plays. Like our biggest overweight position is specialty chemicals. Now, specialty chemicals does not have much reflection in the indexes or markets. And I think that's a sector that has created, amazing consistent wealth for the last 3 to 5 years. And we think going ahead, this is just a sector like what IT was in the year 2000. It's almost a paradigm shift that is happening in India, Indian manufacturing, and the way the economy is positioned. So we are overweight specialty chemicals because we feel that such niches are going to play out. Home improvement is another such area. I mean, people are talking about housing. Some are saying yes, no, commercial real estate, all those fights are on. But one thing that we are seeing, again, we don't have an index for that, but home improvement is a sector, whether you have paints, whether you have adhesives, you have tiles, you have the electricals. So you find that there are a lot of such niches that are happening. So these are more bottom up, but I think that these are themes or niches which will outperform in the years to come. Banks, as I said, there is consensus bullishness, but the market is saying something else. That's my observation, and that's how we are positioned in RPMs.
Okay. I know you probably don't want to give me specific stock names, Atul, but from some of these ancillary or smaller segments that you're talking about, home improvement in the broader markets, are there any specific stocks that you can talk about, or anything else from the mid cap or small cap pie that's starting to look attractive? We love these new themes that you point out.
No, I think home improvement. Again, you have a choice. Someone like me, who's not a very big risk taker, generally goes for the best player in the space. That is, so whether it's paints, adhesives, electricals, tiles, so you know who the best guy out there is. The risk is that, well, they have moved up, they're expensive, but that's my understanding that very often if there is growth, what is expensive today looks cheap tomorrow. So that is something I don't really compromise. I am a growth investor, and I think that these are companies that are reflecting outstanding numbers. And as I said, you don't really need to go massively below the boot. Look at the best player out there, because we know that there is consolidation. Market size is gravitating towards the larger players, the bigger players. Competition is, the big players are really sort of, taking the bigger share of the market pie. So I feel that one should really, once one gets a sense of the segment, just go for the best guy. May be expensive, may have run up. That is the challenge. But the fact is that if there is growth, what is expensive today will look cheap tomorrow. So I think that is the play that is there to do. Speaking about small and mid caps, yes, that's been a phenomenal move that there has been. These are sectors, or they have outperformed the large caps or the frontline Nifty. But again, in this space, it's very important to understand your risk tolerance, because the markets have had a dream 1 year run. It's just been a one straight line with no major correction. A lot of sectors or indices have had 10 months of consecutive positive gains. So the fact is that at some point you will have corrections, and then it is really when the small and mid caps get challenged. And that's where your whole risk appetite comes. Like I tell people, when the market is going up, you want small cap returns. But when the markets come down, you want fixed deposit returns. And that doesn't happen. So it's ultimately about your risk appetite. It's about your risk reward ratio. I personally prefer the large to mid cap space, because when I'm investing in my clients, I'm a custodian of the wealth, and too much volatility is really not good or desired for them or for me. So I tend to be more into the mid and large cap space. There are a lot of money being made in the small cap, but one must remember that the sword has two sides. So you should be also able to handle the volatility.
What about your stance on the PSU space at the current levels?
As I said, that I spoke about that earlier, that PSUs are an ultimate value trade that is playing out, and if value is the theme that is playing out globally, I feel that a lot of PSUs will do well. Of course, the big triggers will be that if we are able to really get going some PSU divestments in India, and that could be a big game changer for the sector as a whole. So I feel that you do have triggers. You have the whole global trade moving or favoring value. And in India's case, if you have some triggers of PSU divestments. So I think they are interesting, but just going and buying any PSU stock or anything, I really don't think makes sense. So I'm not a great lover of PSUs, because I feel that I have a lot of stocks and stars. They've always shown a lot of promise. But if you look at them in a longer cycle, you realize that they have really not created much wealth. So I would rather be a little late when I see consistent earnings. That's most important, rather than some trade that is playing globally, which can change in the whiff of interest rates moving here or there, or PSU divestment when the government does. Well, we've been waiting for it for 6 years. Not much has happened so far.
Okay, and we have been seeing some improvement within the cement space as well, opportunity within mid caps too. Is that something that you'd look at?
Absolutely. Cement has been one hell of a sector. It's been rock solid. And the moves have been, they have been beautiful. They really haven't had much corrections. They don't get challenged with the market's ups and downs. So I think this is a sector definitely which looks very interesting. Again, linked to housing and construction and things like that. So a bit of a derivative on the whole revival in in the real estate space. Interestingly, the real estate stocks themselves do not attract that much fancy simply because they all have a lot of balance sheet issues and a lot of legacy issues. But things connected or supporting real estate look more interesting. I mean, look at housing finance, for that matter. That's another sector which seems to be doing very, very well. So I feel that there are these niches below just the front line. And if you go and identify them and play the best, you really don't need to go and find the 10th best. The larger ones are gaining more market share. I think that these can be very good themes or trends for the next 3 to 5 years.
All right, Atul, we'll let you go on that note. Appreciate your time. Thanks much for joining in with that perspective.